Hello, this is the coach from winningstockcoach.com. Going to go over a little bit of our market overview for the upcoming week, the week of February 3rd, the first week of a new month after what many would probably say is a pretty dismal start to 2014, pretty bad month of January. So, going to go over a few things here in relation to the indices, so you can get an idea of what you might wish to expect moving forward from this point. Now, the chart you see up in front of you is the DJI chart. It's the Dow Jones Industrial Average. It's the Mr. Popular that most people are usually referring to, even though it's, covers about 30 stocks overall. So, but it does have a large impact in the marketplace. So, going to go ahead and start with our overlook here, and I want to explain a few things here. And to do so, I'm going to kind of backtrack from the chart you see and explain what each and every one of these lines on the chart is. First off, I began in my technical analysis with just drawing a simple trend line. This trend line connects the lows from after the collapse in 08 as we got into March of 09 and as the markets bottomed, and a subsequent low found in October of 2011, and kind of using that as my overall trend line on the markets. Now, as you can see, even though there were times where the market was doing great, it came back and it validated this trend line, you get a series of ups and downs while still trending to one direction. Now, many times people see one big red candle on a weekly chart, and all over the media we see, oh, the markets are crashing, you need to pull your money out, blah, 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 blah. I can tell you, over the past year especially, every time they said that, it ended up being the best time to buy. So I'm not completely convinced that they're right this time. So as I look at things overall, I kind of break things down technically in other ways. I started another trend line here off of that October and up through here. And then, as we got into 2013, things took a different course. And again, another trend line, this purple colored one. Now, though the markets have pulled back in January, I don't think the markets have crashed. I don't think they have collapsed. In fact, as of right now, I have more than sufficient evidence to show me that they're actually doing what they should do. They're actually pulling back finally, after not pulling back in mid to late November when they should have. And because they didn't pull back and they extended, the pullback is going to be a bit more severe. The harder something runs, the harder it pulls back. And that's just a fact of how the markets work, how stocks work. So I then break it down with a couple other technical tools. The first tool is a Fibonacci Extension. It's a three-point system that mathematically equates, to make it really simplistic for you, it equates the percentage move between my low point, my high point, and then the subsequent low point to give me a target price, as in, if it were to replicate the percentage move made from here to here, then from here to the next high should display the same sort of intensity. Now, as you can see, that target led me with a 16,837.06 target. Now, there's going to be some plus or minus to this. Nothing's completely accurate all the time. But I also use this same tool to say, well, maybe all these people are right. Maybe there is reason to believe that the market might pull back severely. What reason would we have to believe that? Well, the fundamental change taking place in the global marketplace. What fundamental change would that be? I'm not talking about individual companies' earnings, the fact that they've fudged numbers to beat their estimates, or the fact that we've got a lot of companies that have had a lot of earnings beats time and time again, and yet now they're missing. That's just further proof of the fudging numbers and it finally catching up with you. I'm talking about the quantitative easing. The government-made crutch that we've been standing on. Now you could say, well, no, that's bond buying. That's bond buying. And I could tell you it has a direct effect on the stock market. Many times the bond market and stock market run inversely to each other. You look at a chart like the TLT, you will find proof of that. As the dilution, as the flood of money is happening to increase in bond buying by our government, it's caused what many would say is more stability in equities. The fundamental change is that reduction. It's like taking your crutches that fit to your armpits on a broken leg and knocking them down a notch at a time to see if you can be less dependent on the crutch and more dependent on the strength of your leg. And that's what the economy is being tested with. They are slowly reducing quantitative easing so that they can see the strength in the economy. You know, the numbers have shown, hey, there's reason that we don't need quantitative easing any longer. The stability of the economy will be proven with the effect of the market. So if that were to take place, if it were to come down and maybe it's going to fail my trend line and such like that, I now got to look at, well, if I use this low, this high, and this low to project that target that it nearly hit, it did nearly hit it, close enough for government work. Then again, using the same high, the same low, and then the high that was made, I could project a potential pullback point. Well, if you're a believer in the technicals like I am, you could find that sometime around the middle of March, we might expect to see in that 14,116 range. 14,116.74 is what the tool says. But when you use the same tool on the shorter term, using the high here in a consolidation period through the middle of 2013 to the low where this trend line was validated at and to the subsequent high, what you find is we may have already found a bottom. Though I believe that we could get a day or two, maybe 3 days of consolidation, maybe even a full week of it this upcoming week, so long as this purple trend line is held. We really don't have any concern that the media is flooding us with. Now, I'll be the first to say, if this purple trend line is failed, you may need to exit or leverage your positions on DJI stocks. How could you leverage the position? Well, you could buy some in-the-money put contracts. Puts give you the right to sell at the strike price. So rather than just bailing out of your shares that you may have been holding and grown attached to, you could protect the value of the asset in the purchase of puts. Because at the time that this purple line were to be failed, you would then nearly immediately have to expect a pullback to at least this next trend line. And I think there's more strength in this trend line marked from our bottoms in 2009, and my Fibonacci tool has equated for me a pullback that may match the rate of this pullback right here to bring me down in that 14,000 range. Now, would that be a market crash, a market collapse? Absolutely not. Short-term traders, the media, they want a story. The media wants a story, so they may make it sound like it's a market collapse. I really don't like the word correction, because I think as they put it forth in the media, the word correction means that something got out of hand and we need to correct it. When in fact, nothing's gotten out of hand. The markets have continued trading in a positive trend marked by this trend line since their bottoms in March of 2009. And so long as this bottom trend line is held, long-term positions, though they may not be worth at the time this trend line is met what they're worth today, it would pay no reason to panic. In fact, it wouldn't be the time until this trend line has failed that a high amount of panic would instill in the marketplace. Now, what does that mean? Am I telling you just hold your positions recklessly and wait to see? Absolutely not. But understand the support levels being set here before you so that you can translate those into profitable and smart and justified trade plans for your own positions. So now we're going to take a look at the DJI on the daily chart. You'll see those same lines I had on my weekly chart have crossed over to this daily chart. And I want to show you, a couple key points in this. First of all, through the summer of 2013, to many people it got difficult to trade in the markets. You would buy something and hold it only to see it return basically to the same value you bought it at, to get a big gain again and return basically to about the same value you bought it at, and do it once again in October when they scared you about the government shutdown and all the end of the world scenarios. Many people sold after several months of holding only to find that they really didn't profit, and then the markets raced to record highs. In my opinion, personally, I believe that this period here, if you look at it, this is called consolidation, period of time where the price trades between a specific range horizontally. I believe that's what we may be in store for, is this up and down movement within the same horizontal price mean. And in that case, again, no reason to panic. Okay, so up next we're going to look at the SPX chart. This is the S&P 500. A little different type chart than we did on the DJI. On the DJI chart I showed you candlesticks. Want to give a slightly different view. This is commonly referred to as a mountain chart. And it's based off of the closing prices. Okay, so we're looking at a weekly mountain chart of the S&P 500. And again, in that period since the bottom was last set after the 2008 market crash. So it's starting right here in March of 2009. The one thing I'd like to point out first is you see, just like that Dow Jones Industrial Average chart, we have a channel that started, and we have 3 validation points and low points on it. And what I did is I simply ran a parallel line across the tops, and you'll see there's a time where we got a little bit above it, but we have consistency, 1, 2, and then recently striking in the upper part of this channel. We also have a shorter term trend line. This one begins right there, November time frame of 2012, and catches the fiscal cliff bottom. It catches the bottom set with the government shutdown, and again ran just a parallel line. The reason I'm not so concerned about my top channel lines hitting the tops every time is, quite frankly, I'm more concerned with the bottom, because the bottom's what I have to worry about for capital preservation, and risk analysis should be your number one approach to any type of trading. And what I like to do when I set my upper channel, many would call this a target, is I want to see where I get hits consistently. had I moved this line up to the top here, it would have only hit one time, and I'd have missed that on every other pullback. So when I look at this, I simply look at the consistency. 1, 2, 3, a little blip up here, 4. You'd count this, 5, and 6, got a little above it. We pulled back from it here 7 and 8 times. Now, even though that you may instantly be drawn to this 5-year-long channel that says, oh wow, every time the top was hit, we made a significant pullback, and many times to the bottom, I also want you to look at this shorter term channel and how we closed up literally right in relation to the price of this bottom trend line this past week. So what does that mean to you? What does that mean to the average Joe trader? The ones not backed by billions of dollars of, institutional backing. That means we're already at a point where the market could bounce from. Notice I said where it could and not where it would, because in fact it doesn't have to. But what I want you to see and understand here is that until it fails, we have no reason to assume it will. And again, in fact, this could lead to buying opportunities that you could go back at the end of August and say, of 2013, and say, man, I wish I would have bought there where the media was scaring me out of my stocks. I was selling when I should have been buying because the markets ran to new all-time highs. You could have made that simple assumption simply due to one thing: a technical analysis on the chart. Now again, I'm not saying it has to bounce from here, or even that it will. I'm simply saying that until it fails, until the value has failed, I have no reason for concern. At the point it is failed, I need to look at the reality set forth before me. I have a possible support level here, but by the time this fails, we're probably going to be more likely anticipating this major channel, the one that's been set since the bottom was made, to be hit. Would that be a market crash? Well, let's think about it. Had you bought when this line was hit here, you'd have made a lot of money and would be in no danger of holding even when it hits here, as the line is moving up. The trend is upwards, so therefore the value of it is higher than it was on the last strike. That may not help some positions you haven't been holding since that time, since September, October of 2011. So again, that's where proper leveraging is a key. Now, you may be somebody that doesn't play the options, and I'm not talking to play the options in the way that American greed has made them extremely risky, but extremely rewarding. I'm talking about the way they were intended to be traded, where they can safely position you. They can safely make it so you don't have to buy and sell on a whim, in fear, and making emotion-based trades. You can simply, should this trend line be failed here, look to purchase in the money puts against your common share positions. A put gives you the right to sell at the strike price. And what you may find is, even if we got some very severe pullbacks, that you would once again see this as an opportunity to buy, and therefore could simply sell your puts. Simply sell your puts for profit and roll that profit into your positions. Improper leveraging, it's rarely taught, seems like a big secret of the markets. Something I try to discuss with my members at every opportunity I get. In fact, if you have a proper leveraging plan, if you have a proper optionable trade plan to coincide with your common stock trades on optionable securities, you can theoretically get away with buying any stock at any time without fear, without worry, and knowing exactly at the time you buy it what your maximum risk is. Wow, I could learn how my maximum risk could be set? Absolutely. One of those big secrets of the markets that nobody wants to talk about. We're going to come over now still to the same SPX chart, now on a daily time frame. And we see those same lines I had from my weekly chart are transpired onto the daily chart. And you see again that Friday's close put us right at a potential trend line. You're going to say, yeah, but Matt, now this trend line's a little weird because you got some failures of it here and there's a lot of time spent above it. Understand that it's not so much each individual day's action that you should worry about. In fact, if you are, you're probably finding that you're not as successful in your trading as you could be. So, overall, what I personally do in my own trading is when I have a support level I trust, a support level that I understand, I assume it's going to hold. And if I'm assuming this support level is going to hold, I'm assuming that buying opportunities are here right now. So what if it fails? Well, there's a risk in any trade you might make. There absolutely is. But you could look back and said, man, had I bought just on this line, even when it came and failed it here, if I'd have bought off of this line here, I'd have made outstanding trades every time I made them. When you play the trend, as they say, your risk is minimal in the sense of, even if you don't have a leveraging by options type of plan instituted into your trading, should you buy based on a positive move from a trend line, your risk can still be severely reduced or minimalized by the fact that should the line not hold, you could then exit your trade. There's no rule against selling because it didn't go as planned. In fact, don't let anybody fool you into thinking they've never had a losing trade. The good traders don't have big losers because they execute based on a high level of discipline. Part of trading in the stock market is taking the risks. Manage your risks with an acceptable loss. You have to go into every trade understanding that it may be a loser. But it's not a poor trade so long as the loss you take was planned for and accepted at the time you entered the trade, and you executed the sell at the time that price was broken below. When it comes to simple terms like support and resistance, a good trader assumes that support will be held until it fails. And that resistance won't be broken until it is. That might sound like kind of a stupid phrase to make, but in reality, those simple rules applied to your own trading, If you went back and looked at the charts for stocks that you've looked at, and every chance you look at it, you say, oh, I missed an opportunity. Oh, I thought it could bounce there. And you'll find that more times than not, approaching your trades with those two simple rules, assuming a support will be held until it's failed, and assuming resistance won't be broken until it is, would have made you even more profitable than you may have already been in the past. Now we're going to take a look at the Russell 2000 chart. This is the RUT, commonly referred to as your small cap index. And I want to again look at the mountain chart on the weekly since the market's bottomed back in March of 2009. And first look at this longer term channel, much like we did with the SPX. And on this chart, we're going to see that every time we hit the upper line, we made an abrupt pullback. May not have been one that went all the way to the bottom line, but nonetheless an abrupt pullback was made. Well, here we see that the first week of January, the top line was hit. Now, does that mean it's going to make a beeline down here? Well, maybe. But again, long-term small cap positions you may be holding are going to be best to follow this channel that I have depicted in this lighter purple color. And the reason is plain and simple. Because every time it hit the top here, it only pulled back to the bottom purple line, which we have not at this point failed yet. So don't let this confuse you. Do I think that there's a possibility that we see major indices make large pullbacks? Of course I see that as a possibility. But as I review the different news stories I followed all through 2013, where I was told in May that the market hit its top and it was going to pull back. We were actually told that back in March, but again in May. We were told that in July, heading into August, that taper, market's going to crash. And the average Joe began to sell, only to wish that you never have, or never had. We were told in October that with the government shutdown, the markets would crash. We were told in November that we could expect, the debt crisis and all that going into the new year. Oh, it never crashed. The point is, it remained within this channel. Therefore, I have to trust this channel. But I also need to be aware that unlike every other time that the top of this channel was hit, that none of these hit this long-term channel. None of them hit the long-term channel until just recently, followed by an abrupt pullback immediately following. In fact, 22nd of January hit the top trend line, and we began pulling back at a very abrupt rate. One thing that I would caution in the most is that you take a look at the value of 1121, 1,121. That value is going to be an important value in the upcoming week on the Russell 2000. Because if we close the upcoming week below it, then I would have full expectation for a return down to this bottom trend line. And again, this isn't to scare anybody, because understand that I'm saying as well that positive movement from this trend line could again be another buying opportunity like every other time in which it did. Do not be afraid to buy on positive movement off of the trend line. Be willing to sell should it fail, which would minimize your losses. Now, if you're like me, you may be actually hoping that they bring it on down to this bottom line. Why would one be hoping that? Well, I'm confident in my leveraging strategies. I'm confident that members at winningstockcoach.com will be protected because of those leveraging strategies. And I'm also confident that if it were to come down and hit this bottom channel line, that I would do a whole lot of buy-in and expect to make a whole lot of money. So bring it on down. Bring it on down. But I can't make that assumption until this trend line fails. And it has not yet. So in the week ahead, we need to be very, very observant of that value, 1,121 for the Russell 2000. And those of you that trade small caps and such, that value is going to have a high level of impact on current positions, prospective trades, simply because even though not every stock will follow the indices perfectly, and believe me, even on the way down, I want to point out that even on the way up, you had down spikes. Nothing goes straight up, but it does fall faster than it goes up. Many brokers will allow you to enter stop orders. And understand that should this line be broken, should the price fall below, any upwards movement throughout a then downtrending perspective could be profitable, should you understand that you are to expect lower highs in that process. So very, very critical point coming up this coming week. And I don't believe it'll be something that drags into multiple weeks, because if the market were to go sideways for more than 2 weeks, even at the current price, you would see that we will have already failed the trend line through just sideways movement. So again, don't be afraid of the trend line. On positive movement from the trend line, from support, don't be afraid to buy, because as long as you're not afraid to sell should the trend line be fallen below or failed, your risk will be minimal and you will have a high reward potential. And proper risk to reward analysis is the most crucial aspect to your trading that you will ever find and use. Now, the final thing I'm going to point out in this video market overview today, you're again looking at an SPX chart, and this is a 20-year weekly. What you're going to see on this chart is these two large humps, and then a third large half of hump. I want to point out that in the period from early 1995 till a high point made in March of 2000 was a 5-year up period that was followed by something commonly known as the tech bubble, at which point we followed with a 5-year up period that was followed by a time commonly known as the housing bubble. And since the bottoms were made in March of 2009, our 5-year mark would put us right at this little dashed line that you see coming here, which would be the first or second week of March 2014. At which time one would anticipate, I mean, hey, we've seen it before. Might not have believed it then, but we saw it again. Is the third time a charm. Everybody's always asking me for a bold prediction. What do you think could happen? Well, yeah, I've also got this 1600 line on here. And that was derived from actually marking the price highs here. You don't see it on the mountain chart, but the actual high in price that was made at these two times and run across those tops. My bold prediction is that I won't be surprised to see that by the end of March 2014. And the reason is as they reduce or taper from quantitative easing, the fundamental change taking place in the markets should cause a bit of a pullback in the stock market. And to see if the economy has truly recovered, which is the words that the Fed uses when discussing quantitative easing in general, we would want to see that it could recover by holding the values from the prior highs. And should we be able to sustain that price with no furthering of quantitative easing, then we could truly say our economy has improved and regained the strength seen prior to the housing bubble, as they like to tell us in the media that they're looking for. Right about that time, that could have us really close to that bottom trend line that I was showing you earlier in the video. And while I still believe we may have one more bounce to be made, I truly believe that bounce will be met with a lower high. A lower high than what's already been seen, and will then trigger a downtrend to put us back within the trend, back at the bottoms of our channel that we talked about earlier in the video. Again, nothing to fear with that. In fact, something to praise with that. The best opportunity to buy. Let's think about it. Had you bought in September, October 2011, the last time this channel reached a validation point, would you not have been happy with your return? If you missed that opportunity, are you not looking for it to happen again? And if the economy is not improved, if all the numbers they've been putting out to us are truly propaganda or just false, as many would presume, the jobs numbers that are primarily part-time work, not full-time jobs, if these numbers aren't as good as we've been told, will we be again in a bubble period? And will that bubble period have a long-lasting impact on the markets and maybe draw us downwards to a target in the S&P 500 around 945? That's a prediction I'm not willing to make at this point in time because, quite frankly, I'm a bull. I am a bull and I don't wish for it to happen. But I'm aware of the possibility. I'm disciplined enough to react based on technical points on my charts, and therefore do not fear it whatsoever. This is the coach from winningstockcoach.com, presenting to you market overview for the upcoming week, a little bit of explanation for moving further outside of this week, what you should look for. Remember, never be afraid to buy off support, and never be afraid to sell should support be broken. There's a risk in every trade you make. Analyzing the risk versus the potential reward, and never taking a risk larger than what you've planned and accepted at your point of entry will keep you profitable in trading the markets.